Choosing to spend $36,000 on mortgage insurance probably doesn't sound like the smartest thing to do, but for the average property buyer, it will make you $243,000 more than the price that you pay. Now, there's a lot of myths around this stuff, and to be honest, a lot of the conventional wisdom isn't that wise. So lender's mortgage insurance, or LMI, is insurance that's charged by the bank. It's basically to protect them from you defaulting. Strange thing is, though, that you are the one that has to actually pay for it. Now, to me, that doesn't seem quite right or fair, but that's just the way that things are. Anyone who purchases a property without using a full 20% deposit needs to pay this lender's mortgage insurance at some level, with a couple of exceptions that I'm going to explain. And it's charged on like a sliding scale. Basically, if you use a 15% deposit, then you pay a lot less than if you use a 5% deposit, for example. Now, you can avoid lender's mortgage insurance, or LMI, completely by saving up the 20% property deposit, but in a rising property market, it means that you're falling further and further behind. So I'll show you an example here. In Australia, the average property price is $779,000. So basically, to avoid lender's mortgage insurance altogether, you'd need to have a 20% deposit saved up, which means that you'd need $155,000 in cash savings, a big number. Now, going to the other end of the spectrum, if you only had a 5% deposit in place, your lender's mortgage insurance would be a bit over $35,000. Again, that seems like a pretty big number and one that you'd prefer to avoid. But here's the thing, a 5% deposit means that you only need to save $38,000, or do you save $155,000 deposit? Because in the time that it takes you to save that extra $120,000, the property that you're probably looking to buy is likely to be increasing in value, meaning that you're going to end up further behind. If, for example, you're saving a couple of $1,000s a month, that means that it's going to take you up to 5 years to save that extra amount of cash. And based on the long-term growth rate of property of 6.3%, it means that your $779,000 property is now going to cost you $1,058,000. So you've avoided this cost of $35,000, but you've missed out on $278,000 in property growth, and you're $242,000 behind. Trying to get ahead with this stuff can be like chasing your tail. So sometimes paying the price to get into the market and start getting your property equity building is going to make you a lot more than the price you pay for the LMI.